Good morning and welcome to our conversation starter this morning. It's a great pleasure to welcome you all. Today we're going to be discussing a topic that's very prevalent in the property market, and it's basically just insights into property valuations from a banking perspective. And I want to thank you all for making time to join us today. We have a really amazing lineup of panelists who I will introduce you to shortly. They are from various parts of our business, and they will be going through all the questions that you throw at us during this session. My name is Paul Haslow, and I'll be hosting you today. The real purpose around a conversation starter or these sessions is to engage with you, our clients, in a much more informal environment where we hold richer conversations. And these are the follow-up from our Thought Leadership webinar, which we held on the 25th of May. That was titled South African Property Market and the Key Factors and Trends. It was a much higher sort of a macro look at the market. And with this session, we really want to go deeper in and have a much more micro look at property, and then look at things that will affect your individual property. The valuations are obviously critical in assessing an application for a facility secured by a property. And together with valuations, there are some other factors that influence the final credit decision. And so in conjunction with us discussing valuation methods or capitalization rates, interest rates, we would like to bring some of these other concepts into the discussion. And they may trigger something with you where you've needed to look at that information. And as we've discovered, I think particularly in KZN, our environment is constantly changing, both on a macro and a micro level. You've got the COVID pandemic. Closer to home for some of us is the July looting and the recent floods. And this demonstrates how quickly life changes. And in a flash, these events have affected how a lot of people perceive the world and the environment around them. And the part that we want to demonstrate today is that market values of properties and related credit decisions are not isolated from these shocks and protected from these events. And this can be seen in the current oversupply of office accommodation with the work from home scenarios. And if we look at the knock-on of that is the reduced rentals that are happening across A, B, and C grade offices. The other knock-on effect of something like the COVID pandemic is the semi-grating. All this was discussed in our high-level sort of macro environment discussion in our webinar in May. This webinar is available to you, and we can send it to you. I will let you know the details of that a little bit later. Today, as I said, we really want to look at sort of micro details around the valuation and the things that impact a valuation of a property, and how to get the most out of your property in terms of getting a facility. Before we start, just some housekeeping. In case you have a problem with a freeze during the webinar, just press the refresh button and it'll take you back to where you originally stopped watching the webinar, where the webinar froze. The other thing is we've already received some questions from the viewers. And if you want to submit a question, please use the Q&A chat box on the left-hand side and submit a question during the webinar, and we will do everything we can to get to those questions. Hopefully the ones we've received might answer some of your question. Otherwise, we will deal with it after the webinar. You will receive an email in the next few days with a link to this recording, and you would be able to obviously share it if you want or watch it again. And then just please remember, we do have other thought leadership insights, the recordings of previous webinars, and we can obviously offer those. They're available on our Nedbank Private Wealth SA website. I just want to take you through a little bit of the CVP of Nedbank Private Wealth and Nedbank Financial Planning. We use our globally integrated and advice-led approach to connect your financial decisions to your goals and aspirations. And a big part of this is that your money decisions connect your goals and needs, your dreams and fears, your attitudes, and the role you play in your community to how you earn, save, and spend. This is what we in our business call connected wealth. The fact that every single financial decision you make is informed by and affects every other aspect of your life. Our globally integrated advice makes these threads much more visible and therefore much more manageable. It also connects you to the solutions, services, and expertise that you need to make the most of your money and achieve your definition of success. And I guess the way to look at this in plain language is this means we get up each and every single day motivated by how we can help you make the best money decisions, whether it's in property, investments, structure, fiduciary, and this is all to meet your needs, goals, and aspirations in terms of how you connect with your money. We've gone through that quite quickly, but we really come to the crunch part now, and this is why everyone has joined us. I would like to introduce our panelists to you. As I said, we've already started to receive some questions, so we will get them busy and answering those questions as quickly as possible. Our first panelist is Petroise van Drissel. She's a lending specialist, mostly acquisition-based and based out of Cape Town. Petroise has been in banking and specifically property finance for more than 20 years. And as I said, is based in our Cape Town office. Emma Cornelius is an internal commercial valuer. She's based in Joburg, in our central region. She's previously worked across the Nedbank Group in private wealth, business banking, and CIB. So it has a wide range of expertise across properties, whether they are small, commercial, industrial, across the whole lot. Our third panelist is Kubeshni Govender. She's also a lending specialist in structured lending, but here she's based in Durban. So we're giving some geographic look to how the questions are answered. She's worked in banking for well over 17 years and has been with us in Nedbank Private Wealth for the last 5 years. And our final panelist, last but not least, is Theo du Plessis. He's our regional head in the Tshwane and inland area. Theo joined Nedbank in 1994 and has worked also across many of the divisions and has built up an incredible expertise over this time, originally in commercial banking and then in CIB, corporate and investment banking. He joined us at NPW in 2019 and has been involved in property finance since then. Again, our panelists have a range of expertise, and we're hoping that we can put this to use today. I think going through the questions, I'd like to start with kind of going back to the beginning, if I may, and coming to you, Petroise. This question is really what's been asked is going back to the start. When you meet a client, what are you looking for to establish a lending facility? And sort of what documentation do you need? How would it potentially make the journey through the application process easier and less stressful for a client? I think people are finding applying for finance quite scary in some respects. And I think really it's just in essence is what clarity would you need from a prospective client in order to facilitate an application? Thanks, Petroise.
Thanks, Paul. We are starting off with the very first step in the lending process. That's a very good question, and it's quite a mouthful to answer. But I think it's important to highlight how crucial it is to get quality information in the beginning. And this is to speed up the turnaround times of our decisions and the outcome of an application, and is therefore half the battle. So it's important to put time into and thought into your application. Banks are all about managing risk, and the pricing and suitability of the finance structure is directly affected by the information that we receive. I'm just thinking, in the programming world, there's a saying, garbage in, garbage out, and that's very much applicable in our world as well. Furthermore, another good reason for us to obtain as much good quality information as possible up front is because we forced to do so by legislation. Obtain the information and hold on to it for a specific period in time as a bank. And then importantly, this is the time to build a quality relationship with your structured lender as well, one of trust and understanding, again, to affect the outcome of the application. In terms of the actual information that we would need, there's 3 pillars that we build an application around. And that also determines the information we would need. The first pillar is the borrower. Who is our client? Is it a person? Is it a juristic entity? If it's a juristic entity, who are the shareholders? What is their shareholding percentages? Is it the same entity that's going to hold the property versus the lender or the borrower? What is the financial strength of the shareholders, their personal balance sheets? We may not ask for suretyship of each and every shareholder, but we do need to have an overview of who we are dealing with. Who is the main person managing the property, making the day-to-day decisions on the property? What is that person's experience and background? The next pillar, the property. So here we need information around the property. What is the legal description of the property, the earth number, the street address? Is the property being acquired, and then we need a copy of the offer to purchase. Sometimes we need building plans. We're not going to go into building and development loans right now, and that could be a whole discussion on its own. But we may need building plans even for a straightforward acquisition, depending on the specific transaction. And then any other contract that may affect that property, or the status of the property, or the ownership of the property and the rights of the property. Then the third pillar is the cash flow. So often clients tell me, listen, you've got my property and you've got me as surety. Why do you need to assess the cash flow as well? But the bank is not in the business of selling properties to recoup funds lent out. So we have to show that we are responsible in our lending, and therefore that the facility applied for and approved is affordable. So for that purpose, we need the financial statements of the borrowing entity. Sometimes it's a shelf company, and then we need the financial statements of the entity that we're going to rely on to service the debt. If it's a propco where it's going to be rentals, we need the rental schedules. The rental schedules would include your tenants, start and end dates of the leases, how long that tenant has been in place. Sometimes it's short leases, but the tenants have been renewing often, and that's information that we need to know. If the serviceability comes from other sources, we need to identify those sources. And then back that information up with bank statements showing the actual cash flow through the accounts, and tax certificates, and so forth. But don't get daunted by this list of information, because your structured lender will go through it with you and explain it every step of the way. And I just want to end off my answer by saying it's very crucial for the client at this point in time, in the very beginning, to share any available other risk factors that may affect the transaction. Because if you share that with your structured lender or your banker, they can build mitigants around it up front and build a loan structure to defend against those risk factors. And then it will result in a good experience for both the client and the bank. Thanks, Paul.
Thanks, Patrice. That's very comprehensive. And I think, to your point, not to get too distracted by the list. A lot of it is a progression, and as you build the relationship, so you start to gather the information. I guess a key thing is something like an organogram to at least give the basic structure or your basic business structure, which then can be analyzed by the lending specialist. A second question that we have, and I guess this is one of the main reason why we're here today, is that we look at valuations, and I think a lot of you online have kind of come to the same sort of conclusion: is how do you value, what methods are used? And I'd like to come to you, Emma, if I may. There's sort of it's three questions, but I'll ask them all at once, if you don't mind, and you can pick up them as you go. The question is, there's several types of property valuation methods, and perhaps we can just focus on two, please. And the real place is just to elaborate on the income capitalization versus the sales comparison. And I think that's where people get, particularly with sectional title assets, they get a little bit confused at why you would use one and not the other, and what's the difference. Thanks, Emma.
Good morning, Paul, and good morning to our Nedbank audience. That is quite a jam-packed question. So let me get started by stating that all methods of valuations starts with a basis of comparison. Whether it's price, value, or rates, these are benchmarked in our assessments, and from this we are then able to infer the applicable analysis to determine value. So when we talk about the sales comparison approach, this forms that basis of comparison, and it provides us with an indication of value by comparing the subject property with recently transacted comparable properties where price information is available. So we use this, like you mentioned, for sectional title properties and residential properties where there are frequent transactions that have taken place in the market. As valuers, we are then able to do a comparative analysis in determining both similarities and differences between the subject property and comparable properties. And then we are able to make adjustments to determine value. Adjustments are critical in the sales comparison approach because by the nature, property is heterogeneous, so no two properties are alike, and we make that assessment as we do our research. When speaking to the income capitalization method, an indication of value is provided by converting future cash flows to a single current value. In essence, we are determining value of a property's income producing abilities. Here we assume that the property is fully let at market norms, and it requires analysis of rental rates, vacancies, property expenses, and so forth. And we capitalize the net figure, known as the net operating income, to determine value. The method also involves addressing issues such as lettability and saleability, and this speaks to the serviceability of the property that Pedro has mentioned earlier. A third method is also important to note, and that is the replacement cost. And this simply looks at replacing the cost of the building should anything happen, as we have recently experienced in our market. So.
Yeah, I think the critical part that we suddenly found out, especially here in KZN, and through the rioting and looting, was that replacement cost, and exactly how critical it is to get that absolutely accurate. And I think the key is to revisit that, because a lot of people are kind of looking at valuations saying, well, I've got that valuation, I'll just escalate by a percentage. But actually, you need to have a proper look into the costs of re-establishing a property, including the loss of rental that would come with a destroyed building.
Correct. Just also to remember that valuation is done on a date of valuation. So when we undertake a valuation, it's valid for 12 months. And at any given time, things can change. So when we say a valuation date is for the 1st of June, we are stating that as of the 1st of June, these are the facts. This is what the value is. But those items can change over the course of the period.
Yeah, again, we've had those those big shocks to our market, and if you look at the commercial office market, I think probably 12 months is a very, very long time in that world. Yeah.
Things can change. Vacancies change, rental rates change, and those things have to be considered, yeah.
Okay, thank you very, very much, Emma. and we'll come back to you with some more of the valuation questions as they come up. I'd like to move on to you, Kabesh, now. In your role as a lending specialist, it's really looking at clients who have properties already and are looking to expand their portfolio or use a property to generate equity. So the question goes is, how would clients access equity in their properties and then use this equity as a deposit on a new property purchase or to renovate, extend an existing property? And I think this would go to our refinancing of a property, kind of the retro finance method that we use, where we can use the equity in a property or portfolio of properties to effectively purchase a new property, and then this and that purchase is effectively for cash, which speeds up the process. And then at a later stage, the new property could then be financed. Kabesh, your thoughts on that, please?
I think you've just answered that entire question in its entirety, Paul, but thank you for that. Just to quickly go through our process. It's a very simple process. So what I will chat to you all about now is the existing properties that clients have with us, and thereafter the new property acquisition. So on the existing property side, we would do a very simple exercise, and I'll give you a very simple scenario right now. We would revalue the property to ascertain value so that we can unlock equity in the property so that we can refinance the property and the clients can have additional funds either to renovate or extend the current property portfolio. So the exercise, like I said, is quite simple. For argument, if a client has a 10 million facility and the balance outstanding is 5 million, we can take this facility back up to 10 million or even more, extend much more funding dependent on a new valuation. And what we can also do is refinance the property so that the surplus can be used to renovate the existing property that we do have. So if a client approaches us to unlock equity for a new property, maybe he wants a deposit or he wants to purchase that new acquisition for cash, we will do very similarly. We will assess their property portfolio and to find out if there is equity to unlock to give them further funding. So usually we would take the entire property portfolio and do our assessments and of course send for valuation to ascertain what the actual property portfolio is worth. And most times the new acquisition is purchased for cash, or if the client decides to put a significant deposit towards the acquisition. Now, once the new acquisition is registered and the transfer is done, we can also take the new property and put it into what we call a basket facility, where we can unlock further equity for future acquisitions. So like I said, the process will be to obtain new valuation reports and, of course, also to assess the financial position of the borrower to demonstrate serviceability of the increased loan. Thank you, Paul.
Kabesh, so would it, if the client was planning a future purchase or was looking at making a future purchase, this would kind of be something that we would be able to do now to get that piece in place and then go ahead with the purchase in a month or in 2 months?
Absolutely. So usually because the properties are already registered with Nedbank, it's easier to unlock the equity. And usually the time frames for a new purchase is very limited. So it gives the client an opportunity to negotiate better because they have quite a significant deposit to put, or using the equity in the existing properties to pay for that new property cash. So it's a quicker and a faster process than waiting to bring on the new property and to refinance, to finance from scratch versus refinancing existing properties within the portfolio.
Thank you. Sounds much more efficient, yeah. Our next question is going down to quite some specifics, and I'd like to bring Theo in here, if I may. And this is kind of a lead on from our May webinar, where it's discussing, just asking about the current economic climate and what you can do to increase the chances of renewing a lease or securing a new tenant. And it's really, I guess, the question is, we've seen rental creep. So the A grade offices are now almost charging B grade rentals. And I think, Theo, that the question is how do you make your property attractive to tenants? And I guess more attractive than the property down the road. Thank you.
Morning, Paul, and morning to everybody, and thanks for having me again. I don't know why I always get the difficult questions, but I'll have a go at it. So maybe if we just take a step back and just say, why is it that there are so many vacancies, and why rental rates, like you mentioned, are under pressure, and I think we sometimes overcomplicate things. If you really just take a broad view, the simple answer is that the supply is bigger than the demand. I mean, it's sort of 101 economics. So there are simply more properties available than what we have tenants around. And because of that, you sit with existing tenants that are they are literally pushed to a point where they, in some cases, just trying to recover some of their expenses. Never mind all of it. So like everything else, I think tenants are just sort of looking for value for money. I mean, it doesn't matter what you go and buy. You want the best value for the money that you have available. So and then of course in South Africa you've got the added service delivery issue that's now popping up, and I mean we've seen large businesses moving out of areas, and but that's a discussion for another day. But it's also there in the back of your head. Is the area that you're in, what is the service delivery like in that area? But in any case, so to get back to your question, what can you do? Now, I mean, that's $1 million question. Tenants really want what they had before, but they want it for cheaper. And because there's so much competition, they want better. So think of things like generators. In this time and day, if your building doesn't have a generator, I think you've got a problem. There's an old joke that's not very good, but if people ask you how well or how much you should spend on your security at home, the short answer is just make sure that you spend more than your neighbor, because they're hopefully going to leave you alone and go there. And the same applies in a property like this. If the neighboring property is vacant and it's going to generate it and you don't have it, well, you've got a problem. Think about security, and South Africa security is always at the top of mind. Maintenance, what does the building look like? It's often just what you can see. Then of course there are things like rent-free periods and reduced rates for a period of time, and you see weird and wonderful things that people come up with. But I think it's important just to always take a long-term sort of view when you make these decisions, because property is a long-term investment. We've seen clients signing shorter leases, which is nice for flexibility. Give somebody a 1 year short, and then hopefully in a year's time things have changed and you can up it. Or you may be forced even further down. Banks like long-term because it locks in cash flows longer, but we understand, short-term in this day and age is probably better. Then it may sound basic, but go and find tenants. I often see too many landlords having vacant properties, and there's a to-let sign on, and they phone a estate agent, and what? Go and find the tenant. What is your property best suited for? Who would be best placed to use and to fill your property, and approach that party and say, hey, I've got this space, what are you paying now? Maybe I can give you a better deal, because rest assured, the other landlords is doing it to your tenants, so always talk to your tenants, listen to your tenants. Sometimes we use estate agents and you get distant from your tenants. Stay close to them, speak to them. You'll quickly pick up what makes them tick and what makes them stay with you. Cut costs, operating cost is so important for the tenant. Grey water, solar, DIY maintenance, that sort of thing, and like I said, make sure what your opposition is doing, because your opposition is the vacant property next to you, because he's talking to your tenants, rest assured. So I hope that sort of answered your question.
Yeah, no, I think that's quite comprehensive, and it certainly gives us a wide perspective or a wide lens on the problem. And I think the key as well is that people spend 8, 10, 12 hours a day in their offices or in their where they work, and it becomes quite crucial for them to be comfortable and to kind of feel like a second home, I guess. We have a few more questions, or I can see them coming through nicely. Thank you very, very much for your interest and for actually posting. We have another question for Emma. It's around valuations. It's a two-part question, so I'll ask both parts now, and Emma can have a crack at answering the two parts. The big part, I think, is what people get concerned about with valuations is the cap rate or the capitalization rate, because obviously that goes a long way to determining the risk and ultimately the market value. And as I said, the question here is the cap rate has a fundamental effect on the value of a property. How are cap rates determined for different areas and for different properties? So that's the first question, and I will repeat the second one if you want me to later, Emma, is just so that you can start thinking on it, is okay. What is the effect of interest rates on the cap rate? So we'll park that one for now, and we'll just answer the first, and then we can come back to the second part. Thanks, Emma.
Okay, so the first question is, what is the capitalization rate and how does it determine value? So I previously alluded to the cap rate in when I explained what the capitalization method is, and the capitalization method infers that we are discussing investment property types. So in essence, the cap rate is a ratio and it's an estimation of investors' rate of return. So various factors influences the cap rate, such as the level of interest rates, which we'll get back to, market transactions of similar property types, and then the inherent risk that runs with property. When we say inherent risk which runs with property, we're referring to things like the asset class, the age, the quality, condition of the building, tenant quality, lease profile, all of the things that Theo just previously mentioned, which can either be a positive or negative for a property. Maybe by way of example, if we take an NOI and we say, let's say 100 Rand, and we assume an average property and a slightly better property, the average property could achieve a cap rate of, say, 10%, and then that would give us a value of 1,000 Rand. Whereas a better property could maybe, with a better tenant profile, we could adjust the rate to, let's say, 9%, and we would achieve a value of, I think it is 1,100 Rand, more or less. So here we can actually see the effect that the rate has based on a 1% difference and how the cap rate quantifies value in this way. So the long and short part of the story is that a lower cap rate corresponds with a better valuation and better prospects of return with lower levels of risk. And the opposite is true for higher cap rates. It's also exceptionally important to understand that cap rates largely depend on the contents of the property that's being valued. So it's very property specific, it's asset specific, and the state of the economy. Can you just repeat your second question, Paul?
Yeah, absolutely. Let me call it up. The second part is what is the effect of interest rates? So we've been in a really low interest rate environment, and we've seen over the last couple of months now the increases as they are coming through. And the question really is about, I think that they are alluding to that, is what's the effect of interest rates on the cap rate and hence market values of properties?
Okay, so interest rates are interesting because it directly relates to the 10-year government bond. And in property, this measures the risk-free rate of return. So going back to what risk factors are taken into consideration when we talk about the cap rate. So when interest rate increase or decrease, the baseline for expected risk-free rates shift. Like you mentioned, we've just come out of a low interest rate period and we're heading into a high risk interest rate period. And this essentially affects borrowing costs. And borrowing costs reduces the amount we can borrow, and it has an influence on purchase power. And ultimately what this does, it drives cap rates up. Now, there is a lag between real-time interest rates and the adjustments thereof, which then shifts into the property market, and it just takes a little bit of time for us to, for the market to digest what is happening, and we see that the rates increase.
Thank you. Thanks very much, Emma. Another question that seems to be quite prevalent is and I'd like to come to you, Petroise, on this one, is and it goes, what are the types of financing structures that can be considered by banks when looking at an application? And it goes through the potential structure of either a residential portfolio, commercial or industrial property. And they're really asking, is there a difference? And if so, what are they? Thanks, Patrice.
Thanks, Paul. Yeah, so financing structures are very deal specific, like you mentioned, when you were talking about the different types of properties. And financing structures are normally built around the different factors applicable to that transaction. So that would be, what is the client's actual funding requirement? Is it a working capital requirement, or is it a capital long-term requirement? What can the cash flow afford? We touched briefly, Theo and Emma, and even Kubeshni touched on serviceability and how we generate income through a property in their answers. And that's so important. What can the cash flow afford? How much reliance can we place on it? And what length of forward view can we take on those cash flows? And the quality of that cash flows goes hand in hand with that. And then the type and value of the security that we've got. If it's a property, we can take a longer view on that and build a property finance type structure and so forth. So these factors will influence a loan structure, which is the term of a loan. The LTV of the loan, that is the loan to value. So in other words, what type of exposure we're willing to take versus the value of the asset. And then the amort profile, how it's being repaid. Is it repaid in monthly capital and interest repayments, or is there an interest-only period and then capital and interest kicks in? And that goes back to what the client's requirements and cash flow profile looks like. So there's a number of potential structure configurations, as you can imagine, but we find that keeping it simple is always the best answer. So the simplest route from A to B is normally the best, keeping all of these factors in mind. As structured lenders, we are then able to look at all these factors, put it together in a facility and liaising with the client constantly to make sure that we're moving in the right direction. So the amortization period for residential portfolios are different from commercial portfolios. As you can imagine, a residential home loan could be repaid anywhere between 20 and 30 years in certain instances, whereas an investment portfolio of residential properties, which would be more than 5 residential properties, where the client earns income from those residential units or houses, would then be a residential portfolio, and we would view that as a commercial decision, and that could be amortized over 180 months. But the loan term would not necessarily be 180 months. That would be 60 months with a residual at the end. So what amortization means is just the period it takes for the loan to be repaid from the initial balance in month 1 to where it is 0. And that's where the 180 months come in. Whereas commercial industrial properties, it has to amortize to 0 over 120 months. Then often, as I said, the loan term does not necessarily need to correspond with the amortization period. So we could have a loan term of 60 months with a residual at the end. And what a residual is whatever is left over to be repaid at the end of the loan term. But when we propose a transaction in the beginning, we would know that there's going to be a residual, and we would already have an exit for that residual in the end, whether it is to restructure the loan over another 60 months, or whether it is for the client, perhaps the client plans to sell properties during the course of the loan term and to settle it that way. Whatever it is, we would know that upfront, and that would be part of our proposal to be approved. Then I mentioned briefly that we could have, apart from capital and interest during our amortization period, we could have an interest-only facility. And that would never be because the client can't afford to repay the loan back, but it would often be because the client plans to do something else with that capital portion, which would enhance the property or the cash flows afterwards. For example, he may plan to use the funds to upgrade the building internally, or to fit out for a tenant who we know will kick in afterwards. The lease will kick in. Since repay, the stronger cash flows will kick in after the interest-only period to service the full loan. Another way we could look at structuring a loan is if there's blue chip tenants, and the term of the lease is long enough, we could look at stepping the repayments. So that means that on an annual basis, or in correlation with this increases in the rentals, or the escalations in the rentals, we could step our repayments as well. And what that would mean is that the client would get a bigger loan versus where he would have had to amortize capital and interest from the start. I just want to say that if we stretch the term, the client must remember, and that's going back to 60 months loan term versus 120 months, is that does, sorry, not loan term, but amortization period, that does affect the interest portion. So whilst the capital portion would be lower, and the monthly repayment would be lower because the term is stretched, the interest portion would be more in the end. So it's a balancing act, and you do need to talk to your structured lender about those options. So that's my answer.
Thank you. Yeah, I think you're right in the sense that if you have this conversation right up front with your structured lender when they're visiting your premises for the first time, and say this is, and I think that's where it gets down to the relationship and understanding what your purpose is, or what your plan is around your property portfolio, and then you can start to plan out these scenarios right up front.
Yes, that's so crucial. So that's what I meant when I said from the very start, the client has to have a good relationship with the banker or structured lender, because the minute this information is available, they must work together as a team. The banker or the structured lender is part of your finance team, and you both work towards the same goal.
Absolutely, that's so true. The questions, I'm actually very chuffed. Sorry, that's a very Zimbabwean colloquial word, but we've got some questions coming through, and they keep flowing, which is great. And Kabesh, I'd like to come to you now, if possible. This one goes around, I think we've all mentioned it in passing or in brief in each of the other answers, but it's really around cash flow. And I think everybody understands or should understand that cash flow is the key to any property investment. And if you can just give us an indication on how the net cash flow is arrived at, and how do banks decide on what loan to value to offer? And this goes around the risks that the bank would want to address with that particular property. And I think Emma mentioned some of that in one of her answers earlier. Thanks, Kabesh.
Okay, thank you, Paul. Yes, definitely. Cash flow is definitely key to any property investment. So based on your net cash flow, funding will be calculated. And the calculation is a simple calculation of your total cash flow inflows, subtract your total cash flow outflows, and your net cash flow is derived from your operating activities, investing activities, as well as financial activities. Now, when banks decide on what LTV to apply, we look at various factors. So we would look at the strong lettability and quality and marketability of the said property. So of course, the more lucrative the location is, we will achieve higher LTVs, and lending will obviously be much higher, will be pitched much higher. The debt service cover ratio is a very important ratio as well, which the banks look at, because it speaks directly to a business's financial health and the ability of a business to repay the loan. So yes, the higher debt service cover means the deal is more lucrative. So when looking or unpacking a debt service cover ratio, anything between 1.2 and 1.5 times will be viewed as a very good deal to the bank. Most of our team also chatted around, Paul, the tenant profile, which is key to have quality tenants as well. So national tenants with longer term leases is, yes, they're definitely viewed more favorably versus short-term, month-on-month leases that clients bring to the table. What we also look at from the bank's point is we unpack the financial position of the borrower as well as its sureties. Now, the reason we do this is very important because the client must have access to other surplus cash flows to support the loan in the event that the tenants default. Now, especially when a key tenant exits a property and the client is relying heavily on that rental to repay the loan. So that will bring us back to the risk that the bank addresses, concentration and tenant risk. Like I said, if a large tenant moves out of a property, what would that financial impact be on the client? Can he repay the loan back to the client? Would he need a restructure? And how would that impact his relationship with the bank going forward? I mean, obviously, if a large tenant moves out of a building, the vacancy may lead to a loss of income, and of course, the property values can fall as well. This is where the financial position of the borrower and sureties will come into play to support the loan repayments until that particular vacancy is filled. Thank you, Paul.
Paul,
Sorry.
you're muted.
You're on mute.
It was the first. There was always going to be one. Thank you. So yeah, my take on that is the risk factor when you're looking at a tenant, and if you get a national tenant, they obviously manage or negotiate the rental down, and if you've got a more middle SMME, you end up with a higher rental, perhaps a smaller space, higher rental, and you end up so that the risk piece is changes there as you go. I don't know if somebody wants to pick that up, or Kabesh, you've got on that piece.
I think Emma would be best placed.
Yeah, that's perfect.
So yes, I think the first thing that clients should do is to understand what asset is being looked at, and then consider what that tenant mix looks like. We've mentioned that nationals and franchises offer long-term leases, but typically they also have lower rental rates. So in some regards it's good, and in some regards diminishes your income. If we look at smaller operations and SSMEs, they might have shorter lease terms, but then rental rates are high. So you have to assess what your needs are and then proceed from there.
Yeah, that's a brilliant way of looking at it. Yeah, absolutely.
Sorry to interrupt there, but I think it's important to review the turnover of the tenants in the building. So that's where the history of the cash flow or the rent rolls is very important, because a client might choose to have shorter term leases for a specific reason because of the market he's in, or the economy even. He wants to be able to maneuver, but as long as you know that the turnover of the tenants aren't too fast, or that there's vacancies for an extended period of time during the history of that tenancy in that building, then you can make a decision based on that.
Yeah, sorry.
Sorry, Paul. I just wanted to interject there, just to talk about the vacancies as well. When we look at vacancies, we always take the stance that the property is fully let. So where we see large vacancies, we do apply a market rate, rental rate, and then we account for turnover and actual vacancies as a long-term stance. So we do not over-penalize properties where there are vacancies.
Yeah, because we had an example recently where, to Petrice's point, where we had a sort of a standard superette in a building. It wasn't a Pick and Pay, it wasn't a Woolworths, it wasn't a ShopRite. And if you didn't analyze the building and you just took it at face value, you would say that they're not a national, so therefore there's a different risk. Except when we investigated, we found out they'd been in the building since 1956. The same family had been running the business. It was now third generation. And that kind of gives you a comfort, even though they are not necessarily a national tenant. Okay, thank you. That was a great feedback. Thank you very much. Another question that's come in, and Theo, if I can come over to you, is around the costs of establishing a facility, particularly in the industrial and the commercial space. And I think it's just perhaps if we can provide a sort of an overview of the various costs that that you need to pay in order to establish a facility, and whether these costs could be capitalized, or is it another cash outlay? Thanks, Theo.
Yeah, look, I mean, buying and selling properties is not a cheap hobby. I mean, you got to accept that that it's long-term investments, that you're talking about, and you typically have quite a lot of expenses, deal fees, if you like, upfront, and then also again when you exit, so you always got to take these things into consideration when you talk about your return on a property. But just broadly speaking, I think most of us know the various expenses, but I'll touch on them briefly. So there's obviously the transfer duties or VAT upfront. I'm not going to spend time on the difference, but you only pay one of them, fortunately. But so there's that component, and that's normally the biggest one. Then if you're a seller, you got to pay estate duties. Estate duties. And if you buy an auction, generally the buyer pays the auctioneer's fees. It gets added to your price. So yeah, that's. So there's a transfer, it's the cost of finding a buyer. And then when you get to the bank, we're very nice people. So we start adding our fees, A property needs to be valued. Fortunately, there is fixed scales as far as valuation costs are concerned. So rest assured, the bank do not take a margin on valuation costs. The client pays as is, and in fact we negotiate discounted rates with the various sort of panel valuers that we use. So you actually pay less than you would have paid if you went directly to the valuer. But yeah, there's fixed scales, and it's based on the value and the complexity of the actual valuation. And then once you've got the approval, there's obviously the attorney's fees, and again, we don't take a margin on it. We've got what we call panel attorneys. It's a dreaded word, but that's indeed the case. And you also get discount there, because we send all our deals to a certain panel. And it's because they are reputable, but also because they give our clients preferential sort of fees. And then, of course, there's the bank fees, the raising fees. Now, I mean, that's always the contentious one, but you got to see raising fees in conjunction with your interest rate. A bank incur most of its expenses up front when the loan is granted. I mean, think of all the time and the people and the resources that's involved in putting that loan in place. Whilst in year 2, 3, 4, and up until 10, 15 years, there's nothing. You hopefully just pay your installment, and we happily receive it, and there's no real cost attached to maintaining that. So that's why we charge that raising fee up front, to partly cover that upfront cost that we incur, so that we can give you a lower interest rate over the period of the time of the loan. So always look at the two in conjunction. I've seen many people wanting lower fees up front, but if you go and do the math and see what interest discount you get because you pay that fee up front, it's really a no-brainer. You sort of recover that fee in reduced interest rates in the first couple of years or so. And then, as you mentioned, Paul, it can all be capitalized. So in other words, it can all be included into the loan. It's your choice. You don't need to do it, but we can do it for you.
And I guess then that amortizes it over the period of the loan, which is not, and I get, as we've all said, it's a long-term investment. So getting in, you can amortize those costs over the duration of the loan, except to Petrovisa's point earlier, obviously that increases your interest cost, which is, again, a decision you need to make. We have a question here that's come through, is just a final question before we end off, is, does solar off on the grid increase the value of a property? And I'm guessing this would go to somebody taking the electricity bill down. Would we take that into consideration in reducing the expenses, and therefore you've got to obviously outlay the capital, but you have a saving on the monthly expenses? Would that be taken into account in the value of a property? Anybody?
I'll go. Yes, it does, but not in how the question was arranged. Electricity is an in and out for us, and so solar energy would be its own separate line item in terms of how the specific client deals with generating income, and then apologies.
So it would be, so you would have the cost anyway of the solar, would be an additional already, and then because you'd have to pay for the solar over a period of time, the actual implementation.
Yeah.
Correct.
So absolutely. I mean, we would absolutely finance, if somebody is considering, maybe that's what the question is around, is considering financing solar. Absolutely. I think most banks do, but we definitely do. And where solar does play a nice role, sort of in a property, is in your cash flows. Because remember, you can only sell electricity to your tenants at the same rate that Eskom would have charged. So you can't take a profit on it, but you can step in and earn that income for yourself. So whilst we, from a pure valuation point of view, it may not push up the value that much, it improves your cash flow on a monthly basis. And if you've got an improved cash flow, you can borrow more if that's what you're after. or you can charge your tenant less in terms of rates and be more competitive, than the building next door who's charging Eskom rates. You can't charge more than Eskom, but you can certainly charge less than Eskom.
Okay. So we've come to the end of our time, and I was going to ask everyone to do a summary, but it looks like with the questions that have been asked, we've pushed ourselves to the limit. We just want to, just in closing, I would really like to thank you guys. We would like to just show a quick Connected Wealth video. It's an advert, and we really like the concept of Connected Wealth. If you look across the greater Nedbank group, we have some amazing offerings that we can connect you to as our clients. And that goes back to all our conversations around getting to know you, establishing a relationship, and then connecting you to more. And I would just like to, if you guys could, and then I'll come back and we can finish off, just to have a look at this video, please.
There are many different sides to you. Is your bank serious about connecting your wealth to all of them? Our wealth advisors connect your money decisions to every facet of your life. We call it Connected Wealth.
Okay, and just in conclusion, I would really like to thank you, our clients, for taking time. I know time is an incredibly precious commodity. And again, to Emma, Petroise, Kubesh, and Theo for giving us such great insights. Remember that if we didn't get to your question, we try to get through, I think we got through 10 or 11 questions in the time. If we didn't get to your questions, you can please contact us. The email address is contact@nedbankprivatewealth.co.za, and we will definitely get back to you. I'll repeat that again. It's contact@nedbankprivatewealth.co.za. There's also a QR code which will appear on your screens now. We work really hard to improve our webinars and to garner information from you, and we'd really appreciate it if you would go in and do that short survey. The final matter, there was a question in the chat box around this presentation. You will receive an email in the next few days with the link to the recording of the conversation starter, and then that you can actually share if you think somebody else would get a benefit from watching it. You can certainly send it on to them, or otherwise watch it again. And the other thing, obviously, is if you contact us, we can then send you to our webpage where we have all the previous webinars, and you can then watch those at your leisure. A final thank you to everybody, the guys who put this together, our panelists, and you, our clients. Go well and stay safe. Thank you very, very much.